7 years ago, Marcus watched his brokerage account hit $83,000. He was 29. He had never made that kind of money in his life, and he did not sleep for 3 days. Not because he was celebrating, because he was terrified of losing it. So he did what anyone would do when they are terrified of losing something. He held on tighter. He stopped selling. He stopped rebalancing. He stopped doing anything except watching the number go up, and then watching it go down, and then convincing himself it would go back up. By 2023, Marcus had turned $83,000 into $41,000. $1 million mistake? Not yet. But here's the thing nobody tells you. The real $1 million mistake is not the money you lost. It is the compounding you never earned on the money you should have moved. Stay with me, because that math is going to change how you see every investing decision you have ever made. The first thing you need to understand is something behavioral economists call the disposition effect. It sounds like an academic term, but it describes something brutally human. People sell their winners too early and hold their losers too long. Every single time. Not sometimes. Consistently. Across markets. Across decades. Across countries. A 1985 study by Schefrin and Statman documented it. A 1998 paper by Terence O'Dean looked at 10,000 brokerage accounts and found the same thing. Investors held losing positions 1.7 times longer than winning ones. Why? Because selling a loser makes the loss real. As long as the stock is still in your account, you can tell yourself it is going to recover. The human brain treats unrealized losses as theoretical. Realized losses feel like failure. So we wait, and Marcus waited. Here is what that waiting actually cost him. If Marcus had cut his losses in 2020, moved that $40,000 into a simple index fund, and left it untouched for 20 years of the market's historical average of 10% per year, that $40,000 would become $269,000. He would not need to recover the 83. He would have lapped it. Instead, he stayed loyal to a story he had been sold by someone online who no longer talked about that stock. And that brings us to the second mechanism, the one nobody in financial media wants to explain clearly, because too many people in financial media are the problem. FOMO, fear of missing out, is not a personality flaw. It is an engineered response. The platforms you use to discover investment ideas are optimized to surface content that gets the highest engagement. What gets engagement? Certainty, dramatic predictions, stories of overnight gains. TikTok and YouTube algorithms do not reward nuance. They reward dopamine. A creator saying I bought this stock and made 40% in 6 weeks gets 10 times the views of a creator saying I stayed boring and compounded well for 15 years. Here is what the data says about the hype cycles of 2024 and 2025. During the AI stock surge of late 2023 into 2024, retail investor accounts surge into names like C3.ai, SoundHound, and BigBear.ai. According to Vander research data, retail inflows into speculative AI stocks hit record highs in early 2024. The stocks that captured the most social media attention peaked and then fell 30 to 60% from their highs within 6 to 9 months. Meanwhile, the investors who quietly held the NASDAQ 100 index through the same period captured the actual AI upside without picking the wrong names. The hype cycle made noise. The index made money. The people who actually profited were not the ones who found the right stock. They were the ones who did not need to find the right stock. That distinction is worth about 40 years of your financial life. Now, at this point, you might be thinking, okay, but what about diversification? I am already diversified. I own American stocks across multiple sectors. And here is where most investors have a blind spot, so large they have been living inside it their entire investing life. It is called home bias, and it is costing you more than you think. A study published in the Journal of Finance found that American investors allocate roughly 80% of their equity exposure to U.S. markets, even though U.S. markets represent only about 60% of global market capitalization. This is not rational. It is emotional. You invest in what you know. You know America. You trust America. You watch American news. You use American products. You think American when you think economy. But here's the problem. Between 2000 and 2009, the U.S. stock market delivered roughly negative 1% annualized returns, adjusted for inflation. That was a lost decade. Meanwhile, emerging market equities returned over 10% annualized in the same period. Investors with global diversification did not just survive the lost decade, they grew through it. Adding a simple international allocation, something like 20 to 30% in a total international index fund, is not complicated. It does not require research or stock picking. It requires accepting that the best returns in any given decade might not come from your home country. And for many American investors in 2025, that acceptance is still missing. This is your 2-minute reminder of why you are still watching. What I am building toward is a framework. So simple, it will feel like you've been overcounting the number of ingredients in a recipe you have been making wrong for years. It is coming. Stay with me. Let me talk about complexity for a moment, because the financial industry has a vested interest in convincing you that wealth is complicated. Complexity sells products. It justifies advisory fees. It makes you feel like you need a professional to navigate markets on your behalf. But the research says something different. In 2020, a study from Morningstar found that the average actively managed fund underperformed its benchmark index by about 1.5% per year after fees. That sounds small, but over 30 years, 1.5% per year on a $100,000 investment is the difference between $800,000 and $1.2 million. For $100,000, gone, not to bad luck, to unnecessary complexity. The 3-fund portfolio is not a secret. It is almost embarrassingly public. A total U.S. stock market index fund, a total international stock market index fund, a total U.S. bond market index fund. That is it. You adjust the ratio based on your age and risk tolerance. You rebalance once a year. You do not watch financial media during market crashes. You add money consistently. That is the whole strategy. William Bernstein wrote about it. John Bogle built Vanguard on a version of it. Warren Buffett recommended something similar in his 2013 shareholder letter when he said to put 90% in an S&P 500 index fund and 10% in short-term government bonds. This is not obscure wisdom. It is just unprofitable for anyone selling you something. Now here is the 5-minute check. Because I promise you a truth about leverage that most people learn the hard way, and that is next. Leverage is borrowed money used to amplify returns. It sounds like a shortcut, and it is. It is a shortcut to both ends of the spectrum. When markets move in your favor, leverage accelerates gains. When markets move against you, leverage accelerates losses at a rate most retail investors are completely unprepared for emotionally and mathematically. Here's the math. Say you have $10,000 and you use 2-to-1 margin to invest $20,000. A 25% drop in the market means your $20,000 is now worth $15,000, but you still owe $10,000 to the broker. That means your actual equity is $5,000. You have lost 50% of your money on a 25% market move. And in 2022, many growth-oriented indices dropped more than 30% from peak. A 30% move with 2-to-1 leverage does not cut your money in half. It wipes out most of it. The investors who survived 2022 intact were not the ones with the most sophisticated strategies. They were the ones with the least leverage. Simplicity does not just preserve wealth. It lets you stay in the game long enough for compounding to do its work. Which brings us to the interest rate reset. Between 2022 and 2024, the Federal Reserve raised rates from near zero to over 5%. That single policy shift repriced almost every asset class on Earth. Bonds fell, growth stocks fell, real estate cap rates shifted, and millions of investors who had built portfolios optimized for a zero interest rate environment watched their strategies stop working, not because the strategies were wrong in isolation, but because they were built for a world that no longer existed. The lesson is not that rates are unpredictable. They are. The lesson is that a portfolio built on a single macroeconomic assumption is a portfolio one policy meeting away from serious damage. Diversification across asset classes, geographies, and time horizons is not a boring conservative choice. It is the only architecture that does not have a single point of failure. And now the part Marcus eventually figured out. The part that changed everything. The goal is not to make a perfect investment. The goal is to build a system that survives your mistakes. Because you will make mistakes. Every serious investor does. The question is not how to avoid bad decisions. The question is how to make sure no single bad decision ends your journey. Here is what a failure-proof system looks like in practice. You automate your contributions so emotion cannot interfere. You set a target allocation and you rebalance mechanically, not emotionally. You keep 3 to 6 months of expenses in cash, so you are never forced to sell investments at the wrong time. You vet every financial creator you follow by asking one question. Do they disclose what they own? And do they show you what they got wrong? If the answer is no, they are entertainment. They are not advice. Marcus rebuilt, slowly, without the 30% return promises, without the margin account, without the next big thing. He put $700 a month into a 3-fund portfolio starting at age 32. At a 7% real return over 30 years, that $700 a month becomes $860,000 by age 62. Not a single hot stock, not a single leverage bet, just consistency in a simple system. Here's a reframe I want to leave you with, because I think most of you started this video believing that the biggest risk in investing is picking the wrong stock. It is not. The biggest risk is the system you build around your decisions. A bad stock pick costs you the money you put in. A bad system costs you decades of compounding. It costs you the 83,000 that Marcus turned into 41. It costs you the years you spent watching the number instead of adding to it. It costs you the international returns you never captured because you only trusted what was familiar. The smartest investors are not the ones with the best information. They are the ones who build a process that does not require them to be right every time. They automated the behavior they knew was correct and removed the behavior they knew was emotional. They stopped watching for the right moment and started owning the right architecture. The market does not reward intelligence. It rewards patience, structure, and the ability to do nothing at exactly the moment your brain is screaming at you to do something.